This year, frankly, we've seen more geopolitical risk than, frankly, I've seen in the last 5 years with Ukraine and again the Israel-Hamas war. So that is always going to be something that we're going to have to manage, and why investors are going to have to be nimble. In the U.S., we finally have a speaker now. I think the last time we spoke, there was still the House was speakerless. No government shutdown yet, but there's going to be a lot of noise after the holidays in January and February. The way I'm thinking about the election, though, is yes, it's going to dominate headlines. But remember, historically, if you look at the data, again, S&P has rallied on average 13% in election years. So I wouldn't be as focused with a lot of the geopolitical risk, a lot of the political risk we're going to see domestically here in the U.S. I would focus again on those fundamentals that we've been talking about.
Understood. Brenda, just before we let you go, China, are you in the uninvestable camp at this stage in the cycle, or is there a reason to start scaling in?
Well, here's how our view is on emerging markets more broadly. We are not totally out of China, but in fact, we are overweight emerging markets, and our preferred emerging markets is frankly India over China. India mainly because, look, this is the most populous country. UBS thinks that India is going to be responsible for 20% of global growth in the next 5 years. It's not necessarily cheap, trading at 19 times, but it has come back a little bit, so slightly more attractive from a valuation perspective. And again, we think that Indian equities could return 10 to 15% over the next 12 to 24 months. So to summarize, yes to China, but a stronger vote for India for me.
Right. And I guess you could put Indonesia and Vietnam into that bucket as well from a supply chain diversification point of view. Brenda, we've got to leave it there. Great conversation. Thank you very much indeed.